So we reported last Thursday, of all days. So that was one for the ages. But as Nathan said, we felt that we produced a really solid performance in what was a subdued quarter or a subdued half as well. And so I'll just run you through some of the highlights of that. A lot of these themes will be familiar to you from our previous discussions at Morgan's. But in terms of the half year, just some key stats there. Total passengers, interestingly, were down 0.2% half on half. That's the first negative half we've had probably since the GFC. We've never had a full year down at Sydney Airport since Ansett, etc., back in 2002. So it's an incredibly resilient profile of traffic at Sydney. So we had some interesting dynamics during the half year, which I'll run you through in a minute. Internationally, we had solid growth, 1.9% half on half, but that was below the long-term trend for Sydney Airport, which is that 3 to 4% range. Interestingly, on domestic, you can see there, half on half down 1.5%. So the domestic carriers really managing their capacity quite tightly, I suppose, in terms of that half year. So we saw very limited seats coming into the market. We did see loads on the international side quite strong. So some seats coming out, but the load factors, i.e. the number of people filling those seats, was actually quite pleasing for the half year. Revenue, 3.4% up for the half. Net operating receipts, which is our version of free cash to equity to fund those predictable distributions, up 4.8% for the half, which was very pleasing. Interestingly, operating costs, so controllable operating costs excluding security recoveries, down for the half year. That was a real focus for us, given the traffic picture was quite subdued, as I said. We did make sure that we really managed costs very tightly. We've been working on that for the last year or so, and we started to drive some real interesting and good savings through in the half year results to really create that operating leverage that you've seen at the airport over a number of years. EBITDA, $649 million, give or take, as Nathan mentioned, up 4 and a bit %. Very pleasing in a subdued market. And just also reaffirming that distribution for the full year of 39 cents per security, that growth year on year. So reaffirming the guidance we set out earlier in the year. In terms of the revenue streams, Aero grew quite strongly, international stronger than domestic, as I said there before. So very pleasing 4.7% growth for the half. That's about the international story relative to the domestic. It's about predetermined price increases, pre-agreed price increases on the international side for the aeronautical story. Solid retail growth again. No sort of landmark initiatives in the half year for retail, but again, a pleasing outcome in terms of 4% growth. Property subdued. There's probably stronger growth coming through in the second half in terms of what we're seeing in the business. We've got a new number of executives in the property side, and they've also combined kind of all those non-aeronautical sides of the business. And so they're working through a range of initiatives. I think you'll start to see some traction on some of those in the second half of the year and certainly into 2020. Parking, ground transport, really tied to the domestic story too. So you can see a slight decline there. Again, domestic traffic, which is really the heartbeat of the parking story, as you'd expect, was also down 1.5%, as I mentioned earlier. Capex, bit of a snapshot here. $116 million for the half year. Usual type of stuff for Sydney Airport, a mix of aeronautical, terminal type activities and commercial activities there. You can see some elements of what we're spending there in the half. We expanded the Ibis Hotel from a property standpoint. Some really exciting retail upgrade work, especially the last pieces of the T2 puzzle in terms of the Jetstar Tiger Pier at Pier B. Advertising assets, we put some new digital assets through into the business. We struck a new deal with JC Decode, which kicked off from 1 January. Again, a pleasing outcome, whole of airport. And we put some new digital assets in there to really drive turns on the advertising side, amongst other things that you can see there. Capex at $116 million. That was down half on half. We were looking very closely, and we talked about this at the investor call last Thursday, really looked very closely at the portfolio, just made sure that it was entirely fit for purpose given the subdued conditions in the shorter term. And we actually reduced the pipeline by about 12% in terms of number of projects rather than volume or value. And that was just making sure that we had all the right priorities set up to go. And it's also illustrative, I think, of us being very tight on the Capex side as well as the OPEX side. So that's an important thing just to be clear on. Passenger growth. Again, the story here is diversity of the passenger mix. US was very pleasing half on half. You can see that growth in nationalities over 11% half on half. Nepal was one that surprised us, 19%. So at Sydney Airport, you get pockets, whether it be 6 months, 12 months here, of really interesting growth from certain nationalities. A year or so ago, when I was talking to you, it was Vietnam that was an absolute standout. So you do see off small bases sometimes some really exciting growth. I think what we talk to investors about here is just the diversity these days of the profile. It's a Pan-Asian story. It's not just a China story. Nepal's an interesting story too there as part of the South Asian story. Interestingly, in Sydney, I think Nepal is the third largest source of students right now. So that was something that we hadn't been alert to so much at the airport. So some fascinating subplots in terms of that diversity picture there. On the right-hand side, you can still see that Aussies make up, circa 50% one year to the next of the international picture. The Aussies love to travel. That continued through the half year. And so that's a resilient story for us. We're seeing, I guess, maybe some substitution perhaps of international travel. So as the Aussie falls a little bit versus, say, the US, speaking from personal experience and what we see and feel around the airport, potentially less people going to Honolulu, more going to Bali, Fiji, etc. So no rocket science to that, but people are still very much prioritising in our analysis their overseas trip, but potentially they're just looking at it a bit differently to what they might have done a year or so ago. Just having trouble with moving these slowly.
Perhaps just use the arrow that might be easier.
That would be very clever. Non-aeronautical, so the commercial businesses. Just a few snapshots here. Good diversity as well. New team to some degree on foot and working through a bunch of opportunities to make sure we use our space as efficiently and as productively as we can. Here's just a bit of a snapshot of some of those key stats you'd be familiar with at Sydney Airport. Very diverse retail story, T1, 2 and 3, all different propositions, really high occupancy. Office, strong demand in the precinct around Mascot. We're also seeing strong demand continued at the airport. Logistics is a really interesting space that the team's working on really hard. How does the airport play in terms of that space, given the e-commerce dynamics that we're seeing around the place too? So that's a focus area for the team. Hotels, we did that expansion during the half year, and the team is also looking at a number of new propositions there in the short to medium term. Strong occupancy as well that we continue to see on airport. And parking and ground transport, again, just diversity of mix between international and domestic. And I will use those arrows. Thanks again for the tip. Found them. Capital management, short and sharp. We think the balance sheet's in pretty good shape. We've been working really strongly on that over a number of years. Lowest net debt to EBITDA metric we've ever had since privatisation. Again, I say that each time I come through. Strongest cash flow cover. Strong investment grade rating, BBB plus, no changes to that over the last 6 to 12 months. And really well stacked debt mix that you can see across there. Also very highly hedged, 96% on a spot basis. Again, very similar thematics to what you've seen from us. That is hopefully well managed risk, balance sheet in the right shape. Finally, distribution. Important story, of course. We do understand the importance of the distribution story to our investor base. Simply put, we reaffirmed that guidance for 2019, that 4% growth, 39 cents per stapled security. We've had a compound growth rate in excess of 10% across the last number of years. We've had a really strong period, as you would all know. We are looking at a little bit more subdued growth, of course, in 2019, and we'll see what the future holds beyond that, but certainly a very strong track record there for the airport. We're still seeing cash tax coming into play for us from 2022. So no change again to what we had said to you previously. So that's, again, a strong and very predictable, we hope, distribution story to our investor base.